Meanwhile, the other students join. Good morning, all of you. And let's just do one thing. The case study activity that I had shared yesterday, I was thinking that we'll do that one first, so that by the time other people join, we'll be, done with this. Good morning, Rahul. So what do you people suggest? Just write in the chat box. Good morning, Madhvi. So what do you people think of it? Just let me know in the chat box. Did you people do that case study? Good morning, Harshita. Okay, so I can see that Madhvi has studied the case study. So Madhvi, was there any problem in understanding it, or was the explanation sufficient enough and you could go through it well? Okay, so let's just do one thing. I'll share my screen and then we'll do that one. Okay. So can you guys see my screen? So this was the case study, right? All right. So I'll do one thing. Let's just go through this one. So Vera decides to set up a business selling flowers. So she is the first person who has started her business. Okay. And the kind of business that she started, let me just see. Okay. So the kind of business which she started is that of, okay. So the kind of business that she started is that of selling flowers. How does she procure them? She gets up early in the morning, visits the market, and then sets up a stall by side of the road. For the first year, all goes well. So what is she doing? She thought she got a business idea. She goes to the market in the morning. She procures flowers that she wants to sell, and then she sells it on the roadside. For a year, she did this activity, and the revenue she was able to generate. Now she sells all flowers she is able to buy. So whatever she's buying, for an example, she buys 10 flowers, she's able to sell 10. Okay. And she derives some income from that business. So it was more or less becoming a fruitful business, as it was not a loss making business. Loss would have occurred when, majorly loss would have occurred if she bought 10 flowers and she was able to sell only 5, or say for an example 6, but she's able to sell whatever she's bought. However, Vera feels that she could sell more flowers. Now after a year, she's thinking that if I am whatever I'm getting, I'm able to sell that, why not sell more? If she was able to transport more to the place where she sells them. So now the problem was of that of logistics. She says that I can get only a handful amount of flowers. What if I take a transportation service? If I am able to, buy more flowers, transport to this place more flowers, I can sell more. And she also knows that there are several other roads nearby. Now she says that why only sell that this particular road? There are so many roads around. Why not sell at each road nearby where she could sell flowers? If she could be in two places at once, she's thinking if I can be at 2 to 3 roads at once, I'll be able to sell more, which is very generic. She could achieve these two things by buying a van. Now she thought that in order to transport more flowers, let's just buy a mode of transport, which is a van, and I can transport all the flowers in the van. And by employing people to sell flowers, so she said that I can't be at two places or three places at a time. So let's do one thing. Let's hire people. I will be selling the share of my flowers on this road, and on the other roads, I can employ people who will sell flowers. We need flowers to achieve this expansion. I'm saying I need more raw material. She decides to ask her rich friend Peter. Now comes the second person, who's Peter. She is Vera's friend, to invest in the business. Now, remember we studied in the last section last class that there are three types of people. One is the shareholder who invests in the business. So here Peter is the investor. Okay. Peter can see the potential of Veera's business and wants to invest. See, Peter is now becoming an investor in her business, but he doesn't want to be involved in the management of the business. Like we studied yesterday, that those who are investors are not involved in the day-to-day activities of the business. It is the business managers, it is the directors who are involved in the day-to-day business of a, they run the organization on a day-to-day basis. But investor, if I am an equity shareholder in a company, if I'm investing money in the company, I don't get to see their business. I don't get to run their business. It is only a money game. I am only giving them money. I'm not running their business. So in a very similar fashion, it is Peter who wants to be an investor. He's ready to give her the money, but he doesn't want to be involved in the management of the business. He doesn't want to run that business. He also does not want to have ultimate liability of debts of the business. Now, this is saying about the nature of his investment. Like, he's saying that I will give you the money, but in case you have any debts, in case you have any kind of liabilities, I don't want to be a personal responsible. I don't want to take that as my personal responsibility. I don't want to pay off money for you. I just want to give you the money. You run your business with my money and then give me the return. If it fails, he therefore suggests that they set up a limited company. So he says that in order to protect myself, Peter is saying that I want to protect myself if business does not work out. Let's just get your business registered as what? As a limited company. So yesterday we studied in the class of how important it is and sometimes why investors prefer in investing in a company which is a listed company or a limited company in comparison to a normal unregistered business. So that's what is explained over here. He will own the majority of the shares. Now he's saying that Peter, because he's investing in the business, he's saying that I will own majority of the shares. So he's becoming an equity shareholder and he will be entitled to dividend. So as you all would be knowing, what does an equity shareholder gets? He gets the share on a long run basis. The share price may increase, and that is his wealth creation. And apart from that, the other thing, the set of income which an equity shareholder receives is the dividends. So that's what he's saying, right? So he'll be entitled to get dividends. Vera will be the managing director. Now, the one who started the business, remember initially who was selling the flowers, she becomes the managing director and will be paid salary for her work. So what does this imply? There are two people in this case study. One, which is Peter, he's an investor. Because he's an investor, he will not run the business on a day-to-day basis. He is only giving you money. And second person is Vera, who now becomes a managing director. So she will be the one who will be running the business on a day-to-day basis. She look into the day-to-day activities and operations of the business. And in return, she will be getting as a manager director salary for all the efforts that she's making to run that business. And Peter, being an investor, will get in return dividends for his investment, for his money that he's given. Okay. At the end of the first year of trading as a limited company, Peter receives a copy of the financial statement. Now comes the role of the third person, which is the auditor, right? So we've studied two. One is the investor, second is your director, and now we all come into play. So in the end of the financial year, Peter is able to get a copy of financial statements. Now you all would be knowing what is this definition of financial statements: your balance sheet, your P&L, your cash flows, etc. Notes to accounts. Profits are lower than expected. Now, after seeing the financial statements, Peter, as an investor, feels that when I invested in the business, it had good future, but now the business is not earning sufficient profits. Maybe Peter would have thought, maybe Vera would have told him that, on a year-on-year basis, we'll increase our profits by 10%, but the profits have increased by only 2%. Okay, so his dividend will not be as large as he had hoped. Now here comes a little bit of an accounting role. So we all know what is the dividend. Dividend is a share from profit. The larger the profit a company earns, the larger is the amount of dividend. So how do we calculate dividend? I hope you all know. It is profit after tax minus giving share to the preferential shareholders, and then whatever is remaining out of that pat minus your dividend to preference shareholders is for your equity shareholders. That is something that they can take back home. So more the profit, more will be the chances of higher dividend to the equity shareholders. This is what is explained over here. He's saying that profits were not as high as he had hoped for, and which is why the dividend, which is that investors' income, is low. He knows that Veera is paid a salary. Remember in the last class, we had a discussion there that there exists a conflict. Investor wants his income to be increased, and the directors and managers and other employees want their salaries to be increased. Now, investor will say that I will not increase your salary because your salary is my cost. And if the cost increases, my profit will decrease, right? So Veera is paid salary, so does not care. Now, because as an employee, you are told that every month on month, you will get, say, for example, 50,000, right? So whether the profit goes high or the profit earned is low, Veera will get 50,000 per month. So here she is not worried. It is the investor who's worried, not care as much as him than the profits are low. Peter is concerned by the level of profits and feels that he wants further assurance in accounts. Now, Peter, as an investor, because he's not running the business on a day-to-day basis, he does not know what is happening in the company on a day-to-day basis. So he has a doubt that maybe company is earning the profits, but there are certain amount of personal expenses, or maybe there is some amount of hidden revenue, could be anything. He feels that I want the financial statements to be checked so that I have high level of confidence that this profit is correct figure. He doesn't know whether they give a true reflection of last year's trading, particularly as profit. Now, what is he saying? That Peter feels that the financial statements after a year which are being given to him are not giving a true picture, particularly as profits. Especially when it comes to profits, the figure being stated is not correct as per him, does not have a high reliance on the financial statements, because he predicted while investing that the profits will be high. The solution is that the assurance Peter is seeking can be given by an independent audit. Now, here we come into play. If the investor feels that the profits which are being told by the management that we have earned, say, for an example, 50,000 rupees as profit for this year, investor feels that no, this amount is pretty less, and I want the financial statements to be reviewed for a higher level of assurance. So who will review your financial statement? It's the auditor, it's all of us, it's the ACCA who will go review the financial statements. And after we have reviewed the financial statements, we'll go back to the investor, give them our report. In this case, Peter, auditor will give his report to Peter, and he will tell him that, look, either the profits are correctly stated, they are giving a true and fair picture, or as per me, this was the problem, and this is not the right figure. This one, the new figure, is the right figure, and that's the profit earned. So I hope now it is clear, Madhvi. Madhvi, you can write it in the chat box. Is it clear to you now? All right. Does anyone else also have a question? Because this concept was yesterday's class concept. I wanted to be cleared in through and through. Guys, please write in the chat box so that I can go to another topic. Is this case study clear to you? All right. So let's just move ahead. Now comes accountability, agency, and stewardship. We've already done this. Now here are the examples of your stakeholders, as you all can see here. Who are our stakeholders? Owners, customers. I explained this earlier also. Owners, customers, government, employees, suppliers, lenders, community, society. Just let me see once. All right. Okay, Harshita. So I will not go deep down here again because I've already explained this in the last class. I can give you a reason of why these people are called stakeholders. These people have a stake in a company. These people have a say in the company. Now, I will only explain to you how do these people have a stake in a company. How do these people have a say in a company? Now, owner is the one who's investing in the company. So, of course, it's his money which is being used to run the business. So he has a say. Money is his, right? Society, how does society or and community, how do these two have a say in our business? Now, say for an example, it's a chemical company, or it is a company which is really polluting the environment. So as a society, people might have a problem. There could be way too much of air pollution for the people to handle who are living within that area, within that area where that industry is located. So if they complained about the air quality or the water quality which is being polluted by the company, they have a say, and this could lead to a problem when it comes to the going concern. Industry might have to be shut down only because of the pollution is unbearable for the society and for the people who are living close to that area. Community, so I'll give you a very practical example. Sometimes what happens is that industry is being built in a residential area. So that amounts to, sometimes people feel that it is insecure for their children and all, because if there is an industry nearby, there'll be heavy mode of transportation on the road. Like there'll be trucks, there'll be cranes coming and going. There could be labor coming crossing their homes. There could be a lot of noise. So you have to see whether the community within which you are building your factory, your industry, is okay with the presence of your industry, with the presence of your commercial activities or not. Because sometimes what happens, residential welfare associations, they end up complaining to the government authorities that, it is not safe for our children. The labor is coming day in and day out. There could be cases of theft because of that. We are not comfortable with the factory being within our area, so we don't want it to function within our area, and it needs to be shut down. There can be legal implications. Penalties can be implied on the business holders. So which is why it is very important to satisfy the community and society also, if you want your business to be on a going concern basis. Lenders are the one. See, we get money. A business gets money from two places. One is the owner, who is a shareholder, who is an investor, and the others are your lenders. Who can be your lenders? You can take money from bank, you can take money from debenture holders, you can take money on interest from other people as well. So those people become your lenders. Now, how do they have a say? It is their money which you are using. Now they have to get back their interest. So if you are not getting back their interest, giving them their interest back on time, there is a specific, you will come to that chapter in your law, corporate law. It can lead to liquidation or restructuring if, from a very long time you are not able to pay your interest back to your lenders. So they can file a complaint with MCA or any other regulatory authority, depending on which country you are operating in. And lenders can go file a complaint and ask for the liquidation of a company. Your business can completely be shut down. Your assets can be sold, so that after your assets are sold, the money that comes from selling your business's assets is used to pay off the lenders. So they also have a say. Suppliers, how do your suppliers have a say? So when you are doing business, you are taking raw material in order to manufacture whatever product you are manufacturing from your suppliers. Those who give you the raw material are your suppliers. Now what do they want in return? They want you to pay them their money, for the material that you've taken. Now if you are not paying them the money that for the material that you've taken, they can also file a complaint. They can take legal action against you, or they might stop giving you the particular raw material which you want in order to manufacture your product. Say for an example, you have a business of manufacturing shirts. Now you are taking fabric, say for an example, cotton fabric from ABC supplier. Now it's been 6 months, you've been taking fabric from ABC supplier, but you haven't paid for last 6 months. In the 7th month or in the 8th month, one supplier, that ABC supplier can come to you and say that, dude, listen, you haven't paid my 6 months bills. Either you pay them now, or I will not give you the raw material. Now, if that person stops giving you the raw material, you will not be able to manufacture shirts. If you are not able to manufacture your shirts, you won't be able to sell it in the market. If you won't be able to sell that in the market, you won't be able to generate revenue, right? Now, you people can think that, okay, fine, ABC supplier is not giving me the raw material, then I can go to XYZ supplier, right? But it is about your goodwill also. And sometimes the nature of the raw material is such that you do not have a lot of suppliers in the market. There are only a couple of suppliers, say 2 3 suppliers, so they'll be closely connected. If one supplier, say ABC supplier, goes in the market and says that I am not getting paid by this company, the other supplier might not want to get involved in business with you and might not want to give you the raw material that you want to purchase. So supplier can impact your goodwill and supplier can impact your production. So that's how they are related. Employees, of course, on a day-to-day basis, who is running your business? It's the employees who is running your business. So of course, he is directly involved in the business and he is directly related to be a stakeholder. Apart from that, what does an employee want? Salary, bonus, and income stability, job security. Government, we all know it's an external body, but government is completely and absolutely hands-on related to this to the business. How all the rules, all the regulations, taxation slabs, um, any amendments that come, they all come from government. So your business is being ultimately controlled by the government. If you will get a rebate, if you will get any kind of tax deductions, will it be a tax holiday? Like these days, government is supporting startups. You all would be knowing Made in India, right? So government is supporting startups. So government gets directly related to your gets directly interested in your business. Government is the one that pushes your business. Government is the one that opens doors for your business. Apart from that, what in return government wants? It wants you to pay taxes. So your indirect taxation authorities, your direct taxation authorities, your transfer pricing authorities, everybody is interested in the money that you as a business generate and how much money are you paying back to the government. If you are following the rules and regulations which the government have laid down. So this way is also whether the rules and regulations are being followed by certain companies or not. That way also the government is related and it regulates your business in a manner and it regulates the business environment, business policies also within the country and sometimes outside the country also. Like what are you importing? If say for an example, you are importing from China. Now custom duty could be doubled. Custom duty, it could be stopped. Say for an example, you are not in good terms with a particular country and government can come up with a rule that we are stopping imports and that particular I'll give you a practical example. So say for an example, you are building an X product which requires Y raw material. Now that Y raw material is not available in India. Okay, you source that Y raw material from China. Now we get into some tough situation with China and government stops the import. Now your business can shut down. Why? Because you will not get that by raw material in India. The only source of your raw material was from China, and that was being stopped by the government, right? So, which is why in practical world, we as auditors, we recommend clients that do not rely on one supplier. Have 2 to 3 to 4 suppliers, as many suppliers as you can have for a particular raw material. Because if one supplier shuts down, if the government stops that supplier from supplying you the product, you should have a fallback option because ultimately your goal is to keep on running the business. If the raw material doesn't come, you will not be able to manufacture your product, and that is what any and every auditor recommends the client, right? Customers. Now, how are customers related? No matter how good the product you've made, no matter how much available it is in the market, it is the customer who decides if I want to buy that product or not. So customer again is directly related. Now coming to what does the customer want and why is the customer extremely important apart from generating revenue? You would be seeing marketing campaigns like Zara, like H&M. These days are saying that we are producing very environment friendly clothes. We have recycled clothes, right? Because customer these days is very aware. Customer wants to contribute to the environment. Customer wants to buy products which are not harming anybody, right? Customer wants to buy products that are very that are good for the planet. So a customer basically decides the direction of your business. It is, say for an example, in the utensil industry, if I give you an example, there is a particular company, say, which was dealing in only glass. But tomorrow, say, a trend comes, customers start demanding that we want very eco-friendly products, all right? We want very eco-friendly utensils. So they might switch to from, say, glass straws manufacturing to bamboo straws manufacturing, because customer wants something which can be easily recycled, which is more environment friendly, which is more good to the planet. So customer is the one which will decide the direction of your business, and customer is the one from who you derive revenue. So that again becomes a direct link for and a good stakeholder which you can't ignore. Coming to external audit, I think we did this last year, in the last class or not? Can somebody please tell me if we've done this in the last class or not? Please write it in the chat box. All right. Okay. So, external audits, as you all know, just a moment. Yes, okay. Prem, Madhvi, I got to know that we've not done it and we're doing it now. So we all know, I think we all are clear on what is external audit and what is internal audit, right? So external audit, stat audit, it is financial audit where you do your financial accounts auditing. Now, what are the objectives? Matlab, the point is, if we are doing something, why are we doing it? What do we want to achieve from it, right? So here, when I talk about what are the objectives of external audit, we want to know why are we doing this activity, and if at all we do this activity, what will we get in return? Because not every company, first of all, is required to get your books in account, books of accounts audited. If at all any company is required to get your get its books of accounts audited, that particular company would want to know why, because it doesn't come for free. Uh, in real world, if a stat auditor or even an internal auditor for that matter goes to a company for conducting an audit, you are paid on an hourly basis. You charge the client on an hourly basis, be it your trainee. When the client pays to you, it is a per hour payment, even for a trainee, even for a business consultant, even for a manager, director, partner, everybody gets hourly paid. So it is a very expensive job to be get done by a client. So client, when is shelling so much of cost on you people, they are paying you on a per hour basis. They will take care of your remuneration expenses, like you're traveling, they will reimburse your expenses. If you travel to your client location, you will get that traveling expense reimbursed. If you are at the client location, you want to have food, you want to have lunch, you want to have coffee, everything will be paid by the client, right? So they want to know, apart from all of this activity, why am I shelling this cost? Because it is a hefty amount of payment for a client. So at times what clients say is that, had it not been mandatory by law, why would I want to opt for audit to be get done? So these are the points that tell you why auditing is important, right? So it gives a true and fair view and present fairly in all material respects. So the point is, if you get your accounts audited, you will get to know whether your financial statements are correct in a material aspect. If there are very minute problems, like say for an example, a company is earning 50,000 crores rupees and there comes a problem of rupees 50 or maybe 5 lakhs for that matter. Now that amount of 5 lakhs is very irrelevant for a company that is earning 50,000 crores, right? So all in all, when you get your financial accounts audited, it tells you that on a material aspect, as a whole, your financial statements are giving a true picture and a fair view. All and are prepared in a material respect in accordance with applicable FRF. Now, FRF is something that you will study in FR. What does it say? It says that, the amount of disclosures you were supposed to make. Say, for an example, contingent liability. Do you people know what contingent liability is at all? Please write it in the box so that I can give you a practical example. Okay, so Madhavi knows. What about other people? Do you guys know what contingent liability is? Guys, please write in the chat box. Do you people know what contingent liability is? Or do you guys want me to explain? So no, Madhvi, financial statements may we do not disclose contingent liability as such on the liability side. Contingent liability is to be accounted for in the disclosures. Contingent liability is something that if a particular event happens, we might have to shell out that cost. We might have to bear that cost. We might have to pay for it. But if that particular event doesn't happen, we will not have to shell out any cost. So we may have to pay it, we may not have to pay it. So we cannot book that as a liability in our balance sheet, right? So what we do is, as per FRF, we make a disclosure. After preparing your reports, there are notes to accounts which are being prepared by the companies because it is by law. So in those notes to accounts, there goes a disclosure that while everything is correct, but we are expecting if this event happens, we might have to say, for example, bear a cost of 60 lakhs because this becomes a contingent liability. It may materialize, it may not materialize, right? So FRF gives you the rules, gives you the standards, gives you what is to be disclosed and what is not to be disclosed. So what happens is that when you go as an auditor and check your financial statements, now 60 lakhs of a penalty to bear is a big amount, especially for a company which is not earning a lot of revenue, or maybe for a company which has just started. It's been only 5 years for that company to be in operation, right? So what management would do is that we have just gotten listed, right? We have just gotten listed and we want investors to buy our share price. So what they'll do is, there is no requirement to book a contingent liability in your balance sheet. What happens is, when somebody wants to buy your shares, they first see your balance sheet, they first see your P&L account, how much of profit are you earning, right? So that goes missing because there is no rule. You cannot account for your contingent liability in the balance sheet. So what management cleverly does is that it does not disclose it. It does not give it in the notes to accounts as a disclosure that we are expecting this much of amount as a contingent liability. Now, if I am an investor, I don't know anything about their business. I only see their financial statements and read their notes to accounts, and I do not find 60 lakhs of contingent liability. I might be enticed to buy their share. But if there is a disclosure saying that we are expecting this 60 lakhs of contingent liability to materialize, I might give it a thought that, do I invest in this company? What if it materializes? Or I can go to a competitor share and buy their share, right? So these disclosures also have an impact on the thought process of an investor. They impact the decision making power of the investor. So as an auditor, if I am going auditing your financial statements, I will catch that dude, no, listen, as per FRF, you were supposed to disclose the contingent liability. If you are not disclosing that contingent liability, it will impact the decision of the shareholders who want to invest, who want to buy your shares. So you do that disclosure. I will make sure that everything is right and everything is as per FRF. When I say FRF, it includes your disclosures, it includes following your IFRS, following all your accounting standards, amendments, notes, everything, right? And all of this FRF you will study in your FR paper. But why is it here? It is here because as an auditor, you check whether FRF is being followed or not. Then the third point, financial reporting framework to be applied will vary from country to country. Now see, in general, we have IFRS, but here we are in India, so we follow Ind AS, which almost is copied, but still copied from IFRS only. The intent and the content pretty much 90% remains the same. But from country to country, because of certain amount of differences of how businesses function, certain things do change, which is why you might have heard of US GAAP, right? You have US accounting standards and you have your IFRS. Now there could be some gaps in the accounting standards. So now that is called as US GAAP, so that everything is streamlined after you using US GAPs. So when you are an auditor, say for an example, you are auditing the books of a company who's filing its financial statements as per the rules and regulations of India, you will follow Ind AS. If you are auditing the financial statements of a company which is listed in on US Stock Exchange, which is NASDAQ for your information, so that company will follow your US accounting standards, right? So then you will have to be updated that what do US accounting standards say, and keeping those accounting standards in mind, you will see whether the company is following the accounting standards and filing its books of accounts in a proper manner and presentation or not. Your fourth point is, it is assumed that international financial reporting standards, which is IFRS, are the basis of preparing a financial statement. Now, whenever you start preparing a financial statement, what remains the core? IFRS. Why? Because IFRS tells you how are you supposed to book your revenue. IFRS tells you how are you supposed to book your costs, and this is a first step. Once you do, what is the step of accounting? You first take the vouchers, you make a journal entry, then you do the leisure posting, then you come to trial balance, your P&L, your balance sheet. So the core remains IFRS. So you have to always, even if you are not working as an accounting professional in an accounting field, you are not passing journal entries, but you still have to have that knowledge of accounting standards, IFRS, so that you know what is to be done. When you know what is to be done, only then you will be able to check whether it is done in a manner it was to be done or not. Now let's just see, we have come across a lot of times that financial statement should give a true and fair picture. So let us just understand what is it meant by true, and what does fair view mean. So true, factually correct information which conforms with accounting standards and relevant legislations and agree with the underlying records. Now I'll give you a very practical example. If you, say for an example, are checking fixed assets account, or so what all will you check in fixed assets account? You will check your IFRS, which is relevant to your fixed assets account, which states how the fixed assets are to be booked, what all is to be included in the cost of fixed assets, what all is to be decreased in the or ignored in the cost of assets. So that your value of your block asset comes correct. So that's how you book your fixed assets value, block of asset, right? Then comes other relevant legislations. So once you've booked the value of cost of asset, the next step comes, now that block of assets value goes where? It goes into your balance sheet on the asset side, right? Your non-current assets. That is where you show your block of asset value. But there is another thing that comes, which is your depreciation, right? Depreciation goes into your P&L account. Now, depreciation is also governed by Companies Act Schedule 2. So when you are checking their financial statements as an auditor, you don't only check what your IFRS says, you check what the other laws also says. You have to be very updated in when it comes to all the kinds of laws, rules, and regulations that come into play when you are auditing a particular balance sheet. So here you'll say, when you are checking the depreciation, you will see is the useful life as per your Companies Act Schedule 2. Say, for an example, there is an asset for which the Companies Act Schedule 2 says that the asset should have a useful life of 10 years. But instead, the company has taken the useful life of it to be 5 years. Because if you take the useful life of it to be 5 years, the amount of depreciation will increase. If the amount of depreciation increases, what will happen? It will go into your P&L account, and if it is the increased amount goes into P&L account as a depreciation, it is a component of cost, so your profit will decrease, right? So that leads to manipulation of your P&L, and that means it is not giving a true picture. If your depreciation calculated is incorrect, your profit becomes incorrect, right? So that is not giving a true picture. So you check whether all the rules, regulations, and IFRS are being followed or not. If they are being followed in a right manner, then it means it is giving a true picture. Now comes to fair. Fair, what does fair mean? It is impartial, it is unbiased information. How can we say in a commercial substance, how can we say that your information is impartial or unbiased? Say for an example, there is a director, and the director is putting his or her personal expenses. Say for an example, I am a director of an XYZ company, and I attach all my driver's salary, I attach all my fuel expenses. If I'm going out on dinner or say lunch on a weekend, I say that I've gone for a commercial meeting for my company and I was sitting with the client, so I attach those dinner bills which I had with my family as my business bills. So as an auditor, when you go to a company, when you check those expenses, you ask for their supporting documents. You say that, okay, fine, if the director is saying that I bought a bottle of wine for say 20,000 rupees, I had dinner last month for 28,000 rupees, and he's attached the bills. So you go around, you check whether he was on a business trip, or was he having dinner just with his family or friends, and he's attached those bills. So you check that, because you have to ensure that there are no personal expenses which are being knocked off in your financial statements, because you can't be biased to a director. he's he's as good as an employee who's just a trainee in an organization. So there should be no partiality when it comes to knocking off their expenses. Okay. Now, expectation gap. So this is very irrelevant. It leads to limitations of audit. What is it said? That no matter, like I told you, when we write a report, what we say is that it is not our responsibility to ensure that controls are in place. It is the management's responsibility. We are not responsible for making your financial statements. We are only responsible to give you an opinion that what we feel it is materially giving a true and fair view, but we cannot give you an absolute assurance. We give you a reasonable assurance, right? I told you all yesterday also. So reasonable assurance is we've taken up a sample and we've checked that sample, and as per us, when we check that sample, we could find that it is materially giving a true and fair view. But we are not telling you that it is 100% correct. Your financials are 100% correct. So 100% accuracy means absolute. And what we say is reasonable. So now this is only telling you the limitations of audit. I want you all also to think once what can be the limitations of audit. See, like I said, for a 12-month financial year, we go and check only for 3 months, which is a very less time. So who is sitting at the organization, who is preparing the financial statements, is the one who has more hold on the financial statements, is the one who has the authority and opportunity to manipulate your financial statements, and that is your management. So that becomes your limitation. You have a limited view and limited knowledge of their business. They are the one who are doing it for an entire 12 month, right? So management's intent to manipulate the organization. See, there are hundreds and thousands of bills. You are checking only 10 bills, right? You might catch it, you might not catch it, but it is the management's intent to manipulate. Within those 1,000 bills, they might take a chance that we are giving you 100 bills. We've done 100 bills which are not correct. You might catch them, you might not catch them. So that becomes a limitation. Let's just read it once. So financial statements include subjective estimates and other judgment matters. Now there are estimates and judgments which are being made by the management and not the auditor. I'll take you back to your accounting concept. So what happens? You all might have seen warranty provision, or say for an example, bad debts provision, right? Now some people can say that as per our judgment, management can say that we will book 5% of debtors as a bad debts. Somebody can say that we will book 10%. of our debtors as bad debts. So now that becomes their judgment power and their estimates. And who is responsible for making judgment and estimates? It is the management of the company. So you cannot question them here. That is their professional judgment. And you cannot question the judgment of the client. Why? Because when you go to conduct an audit, you perceive that whatever information that the management is giving to you, it is correct and it is in good intent. They want to run their business. They don't want to manipulate their business. They want to grow. They don't want to shut their business down. So that is one assumption that you also make when you go and audit a particular financial statement. So you cannot question their judgment. But yes, what you can do here, what practically happens is, I don't want you all to just have a theoretical knowledge. So I will keep on sharing the practical aspect of the auditing also, what happens in the real world, because sooner or later you all will become professionals and you will go to a company to do an audit, right? So I'll keep on sharing these instances. So what happens is that 5% and 10%, which I said. So what happens is you do a benchmarking. You say that fine, as per the company, as per us, it should have been 5%, but you are taking 10%. So what you do as an auditor, you check what is an industry standard, what's an industry trend. So the industry trend could be 4% or 3%. If it is closer to the lower limit, right? Say for an example, a company is operating in, say, selling food products, right? Or maybe is an FMCG. So, or your company could be anybody. Like, say, for an example, they are manufacturing automobiles and you are doing an audit of Maruti. So, Maruti, what Maruti does is they say that we book bad debts on 10% basis. As per you, you say that you should book bad debts on 5% basis, but management says that no, it is our judgment, it is our estimation, you cannot question us. But what you can do here is find a middle ground. So you will check what is happening in the industry, what is the industry benchmark. So what you will do is you will check what amount of provisional bad debt percentage Tata is taking, what amount of provisional bad debt is say for an example Kia booking, Honda, other companies in the same industry, what are they booking. Once you do that, once you make a comparative, you come to a benchmark that as per industry norms, other companies are booking 3% to 4%. So you will go back to the client and you will tell them that we are not questioning your intent or estimation, but as per us, the industry benchmark is either 3% or 4%. So the max you can book is 5%. And you will write this in your report. Because ultimately, you are not the one who will get influenced by the client. You are an independent person. Client cannot sit on your head. It is you who has to ensure that client listens to you, and you have to work hard. You have to come up with the proof, which I said sufficient evidence here. You have to come up with sufficient evidence, and then you have to influence the client. Now, the second limitation is your internal controls may be relied on, which have their own inherent limitations. What does this mean? What does this second sentence mean? I want you all to once read this. Second point, internal controls may be relied on, which have their own inherent limitations. What is it saying? So practically what happens is that one company, it gets internal audits also done, and it gets its stat audits also done. Stat audit, now it is well established that it is by law to be conducted, right? So a stat auditor, because stat auditor is taking a limited view of the company and is only checking the financial statements. When the stat auditor forms his or her opinion, stat auditor uses the report of an internal auditor, right? So here, because we are talking about limitations of external audit, and external auditor assumes and relies on the report of an internal auditor. Now, internal controls can have their own inherent limitations. Some controls could not be in place. Some controls could be in place, but might not be operating effectively. An internal audit chapter, we have a different chapter in this course of yours, so we'll get into it at that point of time. But currently, you just have to keep in mind that an external auditor relies on the report of an internal auditor. Internal auditor signifies that all the controls are operating effectively, and once the internal control auditor gives a go to the stat auditor, that is when the stat auditor starts performing its financial audit. Now, third is representations from management may have been relied upon as the only source of evidence in some areas. Now, what happens is when you are going and conducting a stat audit, what you do is you ask the client for the data, because you have to check something. That something comes from the client. Now, that something might not come on time. That something will only come from client. Like, you cannot go to somebody else. So it could be manipulated. So here management has a role to play, and that becomes our limitation, because we cannot go to someone else. It is only the management we can look up to for all and every kind of data that we want in order to conduct and form an opinion, conduct our audit and form our opinion. Evidence is often persuasive and not conclusive. Now, what is persuasive and what is conclusive will come in next chapters, and this is an important concept. If I will even explain to you guys now, you will end up losing the concept here, because it's just one statement. So we'll get into it once that chapter comes. Do not test all transactions and balances, as we operate on sample basis. So this is now, I think, does not require any kind of a explanation. Now, examples. So I've already given you guys these examples. So I would want you guys to, once you get this PPT, I would want you guys to read these examples in case you still do not understand these. Although I have explained these examples, you can come back to me for a doubt and we'll do that. Now, review engagement. Like I told you, there are two types of engagement. One is your reasonable assurance, the other is your limited assurance. So this is what it's telling you. It is telling you that if you are reviewing, doing an in-depth analysis, you are doing performing analytical procedures, you are performing substantive procedures, your sample size is way too large, then you are giving a reasonable assurance. But if you are conducting an audit for a very limited period, it is not an audit for an entire 12-year period. Your sample size shrinks, the procedures, the analytical procedures and the substantive procedures you perform, the depth within which you conduct an audit, your audit procedures, they decrease, and that is when you give a limited assurance. Now comes your first standard. It's just a gist of it. So it says ISA 700 revised. What does it talk about? It says forming an opinion and reporting on financial statements, right? So let's just see what is written here. At the end of the audit process, auditors should be in a position to express their opinion. What is it saying? Once you have conducted your entire audit, you've made your working papers. Now you've collected all the evidences that you had to. Now you should be in a position that you can express your opinion, right? To the shareholders. Who do you express your opinion to? You express your opinion to the shareholders, right? As to whether the financial statements have been prepared in all material respect in accordance with applicable FRF. The auditor expresses their opinion in the audit report. Now, expressing your opinion is your ultimate objective. This is why you are conducting an audit. And where do you express your opinion? You express your opinion in your audit report. If the auditors are satisfied that the financial statements are presented fairly. Now, if you feel that everything is positive, it is giving a true and fair view, they will issue a report which is unmodified. So when as per you, everything is materially giving a true and fair view, the kind of an opinion that you give in your audit report is unmodified opinion. There are three types of opinions that you can give in an audit report: modified, unmodified, and disclaimer. So this again has a different chapter altogether. This chapter relates to where you are given a format, you are told how to write a report, you will be given of what all is included in the report, how do you present it, who all do you present it to, what is your liability, what are your responsibilities and duties, all of this, what is the scope of your assignment, all of this is something that you mention in your audit report. And there is a altogether different chapter on this report. You will have to prepare a audit report, and there can come a case study also in your exam which asks you to prepare an audit report. So it's a good chapter, and you will get to read it once it comes. All right, so this particular PPT comes to an end, and now you all guys would be having I think 10% at least of an idea of what are you into? What all will you go through? What all will you study? What are the different types of audits that you'll study about? What all steps you will study about, right? So this was pretty much an introductory class. This comes to an end. In case you guys want to take a break, we can take a 15 minutes break. I'll charge my laptop and then we'll start with a second chapter. Just let me know what you guys want, please. All right, so Madhvi is saying okay. So let's just do one thing because we've finished one chapter. Can you please share the PPT on the group? On the WhatsApp group, or you want me to share it in the chat box itself? Is everybody comfortable and does everybody know how to download from the chat box? Okay, WhatsApp group. Okay. So I'll do one thing. Once the class ends today, I'll share two PPTs with you people. One will be yesterday's class, and the second one will be that what we've done today, what we'll do today. We are starting chapter number 2. It tells you about the rules and the regulations that are applicable to you people as a professional. If you people are working as an auditor, what rules, what are the accounting bodies, what are the regulatory bodies that have a say in your profession? Who do you follow? Who do you go to? How are you appointed? Right? Once you are appointed, what kind of work is expected from you? How do you resign? Say, for an example, you feel that you might get caught, or this is not the way things should work. You feel that you are the kind of work that is happening in a company, you don't want to give an opinion on it because you have certain amount of responsibility and accountability in the market. Your profession is a highly respected profession, right? People look up to you, so you don't want to give an opinion that might hurt your reputation, right? So if you want to resign from a particular assignment from a client, so you how do you resign? What are the circumstances in which you can resign? Like, you would have seen Deloitte recently said that we are calling off our assignment from Byju's, right? And it had a huge impact on Byju's, right? So there comes circumstances practically also in the market. There have been instances where an auditor has taken a step back and resigned from an assignment because they don't want to be penalized. They don't want to spoil their market reputation. They have a certain amount of duty and responsibility towards the society and their stakeholders. So sometimes auditors do resign. How are you appointed as an auditor? There is a concept of rotation of auditors. Like, there is a concept of cooling off period. That is, for 5 years you can work, or for 10 years you can work for a particular client as an auditor. Once those 5 years or 10 years end, then there is a mandatory requirement of rotation. You will have to leave that client for another 5 years. 5 years is your cooling period. You cannot perform audit for that particular client for 5 years. And after 5 years, you can again go back to that client and you can again perform audit. So you will, again, it's again pretty much an introductory class, but it now becomes a little serious. So post break, we'll be discussing these topics. All right. Bye, and we'll meet after 15 minutes. And I'll be sharing both the PPTs today in the WhatsApp group. Okay. No, Harshita, what audit is not at all about theory. I am currently giving you introductory classes. I am forming a base for you people so that once this base is formed, we can get into the conceptual knowledge. That is one thing. And second thing is, while when it comes to concept, yes, it is theoretical. But once you get into the concepts and you start solving your questions, you will understand that it is not at all theory. You will have to apply that theory, and in order to apply that theory, you will have to apply your brain. So, no, it is not what is written. You can mug it up, you can revise it, and then you can directly write in the paper the same language. No, this is not how it happen. It is going to happen. This is why the passing percentage is very low when it comes to auditing, because a lot of people in the market, what they do is that they memorize lines, they memorize the standards, but they cannot apply that standard. So the essence of it is practical only. You will have to understand what the standard is saying, and then you will have to apply it in your case study. And case studies are going to be very practical. Case studies are going to be the way the industry is functioning in practical world today. How the industry is functioning is how the case studies are being framed. So go with the flow, have faith, and then just start solving questions. Okay. Chalo, let's meet after 15 minutes. So, is everybody back? Can you please write it in the chat box? Can we start with the class? All right, so let me just share my screen, and please let me know if the screen is visible to you people. Is my screen visible to you people? Is my screen visible? All right. So now we are talking about our chapter 2, which is rules and regulations. Okay. So this is the index. That's what the entire chapter looks like. It has a lot of references from your corporate law. Can you people just tell me in the chat box if anybody or how many of you have been through your corporate law paper? All right. Okay. So I'm assuming that most of you have no idea about corporate law, so that would define the extent of my explanation. So let's just go ahead. So index of the chapter is what this looks like. Regulatory environment within which external audit takes place. So what kind of an environment by rules, by law, by regulations is required to conduct an external, again, stat audit, right? Reasons for regulations of auditors. What are the reasons why are auditors being regulated? There are certain bodies that you will come to know in this chapter who regulate the auditors, who we are answerable to, who we report to, who we come under, who we have to follow to. So why are there any regulation requirements for the auditors? Now I'll give you a very basic example. So why are there traffic rules? Because we don't want people to lose their lives. The government doesn't want people to die on roads. So which is why in order to prevent any mishap, there are traffic rules. In a very similar manner, there had been certain amount of frauds within the companies, and auditors could not either catch it or could not or were in hands and glove with the client, which is why the market crashed. A lot of people got affected financially, governments collapsed, banks collapsed, and this all happened majorly in USA. There is a company called Enron. So there was a fraud conducted day in and day out. You would, if at all you people read newspapers, news, you'll see that somewhere around the world globally, either KPMG or EY or Deloitte is being imposed penalty over. They are paying penalties for negligence and stuff, for not performing their work well. So auditors are regulated for the reason that you have certain amount of responsibility and accountability towards certain bodies and your stakeholders, because people are dependent on you. People take decisions basis your opinion. So if your opinion turns out to be drastically wrong, and if it is found that you gave your opinion only in a very negligent manner, you did not perform your duties well, your firm can be shut down, your degree can at times in very extreme cases be taken, you could be liable to penalty. So we'll discuss all of those in your ethics chapter, and we'll here discuss why is there a need of regulation over auditors, what had happened. Do you people know what SOX is? Sarbanes-Oxley Act. Please write it in the chat box. Do you people know about SOX? Have you ever even heard the name? Okay. So basically, SOX came in USA. It is mandatory to be followed, and all around the globe, people are following SOX. There is IFC audits, there are ICOFAR audits, there are SOX audits happening all around the globe. It came in USA because there was certain amount of companies that went down, and the banking system completely collapsed in 2000 era in the USA. The market was hit badly. A lot of people went bankrupt. A lot of people died also. Like here also, there was, I think, Sahara company that had gone down the drain, and there were a lot of investors who had so much, who had invested so much, especially the people who are in tier 3 cities. They also invested in Sahara. They were dependent on their dividend income, which came from Sahara share. And once the company collapsed, a lot of people were hit because they were dependent on their day-to-day income, which was coming from Sahara, and there were a lot of people who went bankrupt because they had taken loan and bought the shares. So a lot of people get affected and impacted if you give a wrong opinion, if you say that things are correct in a company and they turn out not to be. So you need to be regulated in order to prevent the entire community, people around the society, government, banks, etc., because everybody does look forward to your opinion. Stat regulations, regulation governing the appointment, rights, removal, and resignation of auditors. Now, it is not that if you are appointed once, you cannot be removed by the client. So it is a very thin line, and you have to have a good relationship with the client, especially I am talking when it comes to your practical experience, right? So you have to maintain a good relationship with the client, but still you have to be independent, right? When you are forming an opinion, when you are writing an audit report, you have to keep in mind that you are all ultimately accountable to the stakeholders and not to the management. But because you have to come to that conclusion, you have to come up with an opinion, you need to have a good relationship with the management, because it is the management who will give you the data so that you can perform the activities that you need to in order to gather evidences and form your opinion. Now, there is a particular written formal procedure that a client follows that you also have to follow before starting your assignment. There are certain rules and regulations for you to be appointed. Not everybody can become a stat auditor. What are your rights? Like, for an example, remember in the first class we discussed about engagement letter, right? So in that, if you've written that I want these documents, I want full rights, I want to have information about what is happening in your company, I should have a right that I can go to your legal team. What is the legal team? They are your CS, company secretaries, and your corporate lawyers. So if I feel that the evidence is not sufficient which is being provided by you, I should be allowed, this is my right that I can go to your legal team, I can go sit with your corporate lawyers and discuss about the case. Because as per me, if the management says that, there is a the expected penalty of 5 lakhs, but when I study that case, I feel that no, if it materializes, that penalty can go from 5 lakhs to say 15 lakhs. And management says that no, what you are thinking is not correct. It is my right that I can go without the management's presence, without my client's presence. I can go, I can sit with their lawyers, and I can discuss the case of what do you think. I have the right to go to other people. You write balance confirmation letters in direct and indirect form. You will get to know about these letters also later in the course. So say for an example, you all understand who debtors are, please write it in the chat box. Do you people understand what receivables or debtors are? Cool. So, debtors are the people from whom we have to take the money. Now, what happens is, if a company is planning to manipulate their balance sheets, what will they do in order to increase their current assets? They will book fictitious sales. Fictitious sales is that you haven't sold it, but you are showing that that material is being sold on credit sales. Now, what happens? Your credit sales increases, which means, what does credit sales means? I have given, say, 10,000 rupee 10,000 rupees stuff to XYZ debtor. Now that debtor has taken material from me and will pay me on a later stage. So 10,000, from 10,000 my credit sales will increase, and from 10,000 my debtor's balance will increase. Now if the debtor's balance increases, it is reflected in my non-current assets on the asset side of the balance sheet. Now this gets into this can be manipulated. So what I'll do is, when I'm checking the debtors, when I'm checking the debtors aging is from how long this particular debtor has not paid me, right? So when I'm checking your debtors, what my client's debtors, what I'll do is that if I feel that there is a particular debtor, say XYZ, and it is reflecting in the account that this particular debtor needs to pay me 10 crores rupees. Now, as per my professional judgment, when I look the sales figure, I might feel that 10 crores is a very irrelevant amount, or I might feel that 10 crores is a relevant amount. Basis my professional judgment, I can directly shoot a mail to that particular XYZ debtor and ask them that please confirm me, are you supposed to give 10 crores rupees to my client or not? Please confirm your balance. Now, if that debtor says that no, 10 crores is not what I owe to your company, I only owe, say for example, 2 crores. I have to give only 2 crores to your client. Now, there is a gap of 8 crores. I can go back to the client and say that I have received a confirmation letter from your debtor that he does not owe you that much of amount. There is a gap of 8 crores. So client cannot question me that why behind my back you went to the debtor and asked for balance confirmation. It is up to me. It is within my rights to go and talk to people in order to gather evidences, in order to frame my opinion. The client cannot question me on this because this is my right. Removal, and this is just one example of my right, we'll get into it in the chapter. Removal. So once you're appointed, it is not fixed that you will continue. It is basis client's judgment also at times, or it could be that there is certain regulation, there is certain law that you broke, which is why you will have to be removed, right? So what are the cases in which as an auditor you can be removed from the client's location and the assignment as well? Resignation, like I told you before the break also, what are the instances wherein you as an auditor can feel that, I need to resign? What will be the procedure to resign? Like, you can't just go to the client one day in the morning that, okay, fine, I will not come to your place and I'm not doing your audit. No, this is not how it happens. There is a particular process, certain amount of documentation required. You have to inform the accounting bodies and the regulatory bodies that you have resigned. You have to, within the company also, like say for an example, you are dealing with the senior management or senior managers and managers who are the employees of the company. You feel that no, you don't want to continue with this particular assignment, so instead of going to the manager or senior manager, you will go to those charged in governance, which is maybe your directors, your audit committee directors. You'll go to them because ultimately you report to them, right? So you go to those charged with governance people within the company. You tell them that this is my reason and I am resigning, right? Apart from that, there could be other accounting bodies also, which you will get to know in this chapter, wherein you go to those bodies, you give them a written letter, you intimate them formally that this is the client, I am resigning from this client, these are my reasons, and I have taken all the steps that I could have taken before resigning. All right. So because you are accountable, you are responsible, and you are answerable to people, certain accounting bodies also. So you will have to write an email, give them a written formal intimation that you are resigning from this client and this is your reason. Now comes the fourth point: regulations governing the rights and duties. What are the laws that govern your rights and duties? As an auditor, you should be independent. How will you become independent? When there is a written law, when there are written rights that you have, through which you can operate independently. But see, responsibility and rights come with duties. If I'm responsible for something, I will have to do something for it. So what are your duties? You can't just go to your client's place. You can't just go in the morning, sit, have your sip your coffee, then order some lunch, and then get back to your home. No, that is not how you function, right? So you have certain amount of duties also, which are correlated to your rights. Fifth point, development and status of international standards on auditing. There are certain amount of bodies. I have written these bodies: ACCA, ESB, IAAPB, so IFAC. So these are all the accounting bodies that talk about your accounting standards. These are the one who frame your accounting standards. These are the accounting bodies who regulate you. These are the accounting bodies you go to when you feel like that you need some assistance, you need some guidance. These are the accounting bodies you intimate when you are resigning. So we'll get to these also. Please consider that this is just an index, right? Relationship between international standards on auditing and national standards. So there are certain amount of every country has its own standards also, which are their domestic national standards, and there are certain international standards like global accounting standards. These are global accounting standards which are worldwide, and every company picks up something or the other from them, and then they have accounting standards which are operative within their country's boundaries. So what is the relationship between them? Now comes, then again, what I've just explained you. This is what I've written here. Once you'll get the PPT, please read it. Now, what is the need of regulations? Like I gave you an example of traffic rules. So let's just once read what it is. To regain trust in the auditing profession, sometimes what happens is that there have been instances when when auditing professionals got lethargic. They did not gather sufficient evidences. So what happened was that what could have been caught did not get caught, and people got affected. So now you have certain set of regulations which you have to follow when you are performing your duties, so that there is trust in the market when it comes to your profession. See, because it is all a game of trust. Why are you being respected? Why do you as an ACCA have value in the market? Because people trust your opinions, people trust your professional competence, people look up to you. And when do people look up to you? When do people trust? When you have a goodwill in the market, when you are giving them what they want, when you are performing your duties right. So it is very important that you are regulated. Say for an example, why when I give my money to somebody, why do I prefer keeping my money in the bank? Because I know that there are n number of regulations, n number of bodies that are governing, regulating the banks, right? So I feel that my money is safe with the bank, because so many bodies are governing and regulating the bank, the financial companies, which are the banks majorly, right? So in a very similar manner, why does a normal MBA, who also MBA finance, who also has a similar course, why doesn't simple graduate, why doesn't anybody else from the same commerce field allowed to sign the report when it comes to your stat audit? Because they are not being regulated. You do your college from, say, SRCC. It's a very well reputed college when it comes to Delhi, right? It is one of the best colleges. You graduate from there, but does that give you an authority to sign the audit report? You might be equivalent. If you have graduated from SRCC, you could be equivalently sharp when it comes to in comparison with an ACCA. But still, that graduate from an SRCC is not being regulated. So the trust level will be a little less. Okay. Now, what is harmonizing of auditing procedures, so that the users of audit services are confident in the nature of audits being conducted around the world? So focus on harmonizing and around the world and audit procedures. These are the three things you need to focus on. Harmonizing means synthesizing, keeping getting things on the same platform, irrespective of which country you are working. Like for an example, IFRS and Ind AS, majorly the base remains same. A little bit changes here and there, but majorly the intent and the content remains same. The same is with the auditing standards, global auditing standards and national auditing standards. The intent, the content, the base remains same. A little bit changes here and there. Now, why is this important also? See, it's a global world. We go beyond the boundaries when we do the business. You can see Reliance, you can see Tata, you can see Aditya Group being listed on Nasdaq. Nasdaq is the stock exchange of USA. You can see a lot of UK companies. You can see a lot of German companies. You can see a lot of Japanese companies who are operating here. So now you have to synthesize your auditing standards so that it becomes easy for conglomerates. Who are conglomerates? Conglomerates are the ones who are operating in a lot of countries. Now, imagine the amount of compliance they have to do. There is a company which is, say, for an example, let's take an example of Coca Cola or maybe PepsiCo. They have their presence in almost I think 189 or 192 countries. Coca Cola and PepsiCo are present in these many countries. Now, imagine if there are accounting standards different for every country. How much of compliance, how many rules and regulations will come into play, and the finance teams, the auditing teams will remain confused. If I am sitting here today in India, I can audit. You must be knowing also, like there is EYGDS, there is Deloitte USI. So what does Deloitte USI do when it comes to stat audits? They are able to perform stat audits for companies who are listed on US stock exchange, or maybe companies who are there operating in USA, not just Indian companies who are in USA, who are registered in USA. They are auditing their books while they are sitting in India. Now, how can they do this? Because there is simplicity, there is a common ground, a little bit of amendments here and there, and people can understand what is happening there. If you are an ACCA, if you are a CA from ICAI, or if you are a CPA from USA, you will have similar knowledge. You will have a similar understanding of your IFRS, your accounting standards, your auditing standards, corporate law, taxation laws, international taxations. Almost everything is pretty much same, so that everybody is on the same page and on the same radar. Focus the audit quality. Now, one thing is you are performing something. The other is, say for example, food. You are cooking food, right? You are doing it with a good, you are giving me good quality food, you are giving me poor quality food. So when you work as an auditor, you have to maintain quality. You have a standard to maintain in the market. So which is why you need to be regulated, because when it comes to regulation, in regulations, you are told what kind of an audit report are you supposed to prepare, what is the format in which you are supposed to roll out your audit. You can't say that I am writing ABC here and then XYZ starts and then EFD starts. No, you have to follow a certain amount of procedure because it is written in the rules and regulations, so that it is easy to understand. Every organization can understand it, and every professional, irrespective of their background, ACCA, CA, CPA, they all are on the same page and issuing a report pretty much which is same on all sides. Adherence to strict ethical code of conduct. You have a separate chapter when it comes to ethical codes of conduct, and to try and improve the perception of auditors as an independent, unbiased service providers. Now, say for an example, for a 5-year period, KPMG is going day in and day out at the same client's place, at the same client's location. What happens is ultimately you gel up with the client because you are seeing them on a daily basis. You are interacting with the client on a daily basis. You are sitting in their on their floor. You are having lunch with them, but still you have to maintain independence, right? So it is a very thin line. It is difficult sometimes, which is why there is a need of rotation of auditors. After every 5 or 10 years, the teams get changed, the auditor gets changed. Yet within those 5 or 10 years, you might build up a personal relationship with the client. So how are you going to maintain your independence? How will you stay unbiased? When I say stay unbiased, what do I mean by this? Say for an example, you caught something which a manager was doing wrong, and it was financially impacting the company. Now, say I'll take an example that say there was a 5 lakhs amount which was being forcefully charged to the company for personal expenses by the manager. Now you catch it, but the manager who's done this is the manager you sit with for your coffee, is the manager you sit with on the same table and have your lunch. You are seeing that manager day in and day out. So there comes a human factor that no, we are friends, and we know each other. I did a particular mistake and I will not repeat it. But this so you can be a little biased towards that person, that it and it was just a one-off thing that that person has done. And if I report it, that person might end up losing his job, right? So you will always have to face these situations. You will always have to find a middle ground as an auditor, which is why somebody I think asked me about whether it is a theoretical paper. No, it is not. You have to apply a lot of your brain into it, and it is very practical. And even when it comes to the real world, you not only have to be smart theoretically, you have to be street smart also for this profession. You should know how to navigate among people. You should know how you are supposed to react very professionally, firmly, and quickly also. You can't take a lot of time at times. So you have to be very street smart also when it comes to you being an auditor, because most of the time you are on a client facing role. So you will end up interacting with people who are double your age. Currently, if you people get into your training period, you could be somewhere between 19 to 22, and you would be interacting with someone who's 45 or maybe 55, right? So you have to build up that street smart skill also for this. Next is to achieve this practitioners. Practitioner, I explained in the last class who are practitioners. They are auditors, ACCAs, CAs, and CPAs. Have to follow regulatory guidance. National Corporate Law, that is your Companies Act, your 2013, 2014, 2016, as per UK. Now here comes SOX, which is coming from UK, the USA. Then accounting, auditing standards, international standards on auditing in case of ACCA, Code of Ethics, which has a separate chapter. So now I hope you all are clear when it comes to the index. Please say once yes or no. Although I don't think it required much of explanation, because it was just pretty much less explanation required here. Can I move forward? Guys, please say yes or no. All right. So what are the legal requirements for audit and auditors? This portion, yes, it is theoretical, but you should know, because if you want to become an auditor, you should know what legal requirements and what your boundaries are. Okay. Which companies are required to have an audit? Every company cannot get its books of accounts audited, especially your small companies, right? Companies that are private companies, your partnerships, your LLPs. So what company will you audit? Say for an example, you want to, after having your degree, you want to start up a practice. So you cannot go to an unlisted company or a very small company or a one person OPC company that hey, I'm a chartered accountant now and I want to audit your books, will you be my client? No, you should have an idea who can be your client when it comes to auditing, what kind of services you can provide to whom. So and this is a part of your corporate law, by the way. that what companies require auditing, who can and cannot carry out an audit. So, majorly, I think we all are in consensus that there are majorly two types of audits. One is your stat audit, external audit, and the other is your internal audit. Now, who can be your stat auditor and who can be your internal auditor? What happens is that stat auditor cannot be your employee, but an internal auditor can be your employee also. There are internal audit departments also. Like I am also working at Urbanic, and I am working as an internal audit manager. But I sit with the company and I am on company's payroll. But stat auditor cannot be your employee because they give their recommendation on the financial statements true and fair value, and so that person cannot be your company's employee. While stat auditor is necessarily required to be a chartered accountant, but internal auditors can be your MDAs also, but there is no hard and fast rule that a person should be a chartered accountant only if that person is working in internal sector. But when it comes to stat audit, the person is mandatorily supposed to be a chartered accountant. It is by law because you sign the report, and only if you are a CA you can sign the report. Then again, auditors' appointment, resignation, and removal is something that you look into, and the rights and duties of the auditors. Who needs an audit and why? In most countries, companies are required by law to have an audit. Like I told you, when it comes to stat audit, it is mandatory exercise which a client has to get done. Small and owner managed companies. What are owner managed companies? These are one person companies. That is, there is just one person who's the owner and he got himself registered as a company and he's the manager, he's the director, he's signing the financial statements, he's responsible for getting them prepared. So that is a one person company, are often exempted. Now these companies need not get their audits done. Why? Like I told you, it is a expensive exercise. You end up shelling out a lot of costs. So why burden these companies with that regulation and law? So it is okay. And plus, small companies, yeah, one person companies, they do not have that many transactions, and they do not even have a lot of people looking up to them. Like uh, Tata, Reliance, any kind of a listed company, people are buying their shares, people know about them. But any small company or a one person company, people might not be interested in investing in them only. So why have an audit report if nobody is looking at it only? Note that these exemptions often do not apply to companies in certain regulatory sectors. Example, financial services companies. So what do you guys have an idea when it comes to financial service companies? Banks, NBFCs. Now banks, almost all of them are listed, but NBFC might not be a listed NBFC. But again, because it is being covered under regulations of financial services companies, it will have to get its accounts audited. So it is not only the company's law that we look into. It remember I told you guys in the last class, you have to first, before starting an assignment, see who is the client, which industry is it operating in. Because once you get to know what kind of industry is that client operating into, you get to know what kind of rules, regulations are applicable to that company, right? So there could be an NBFC which is not registered, which is not listed, but still will have to get its books of accounts audited because it is mandatory by law to get them their books of accounts audited. Now, reasons for exempting small companies. It is not really relevant when it comes to your exam. So just have a look at it, just read it. Once you get a PPT, it's very generic. In case you do not understand something, you can ask me in the next class, but it's pretty much irrelevant here. Okay, I have gotten a message. Yes, so Madhvi, once we get to that topic, this topic is in this chapter, and once we get to that topic, I'll explain it to you in depth because it is an important topic. But I am for once covering everything, even if it is not that relevant when it comes to your exams, because you should have an idea. You don't know if a case study comes. Say, for an example, a case study could come that you have 10 company offers wherein you can conduct an audit, and one of the companies is a small company. Now, if I will not explain to you that you don't, there is no mandatory requirement of getting a small company audited, you will forget it, right? And if you forget it, if you do not revise it, you might end up losing even if 1 mark. See, every mark matters, right? So you should have a conceptual understanding. Keep faith in me. I have 10 years of experience in auditing. I will not teach anything which is not required, but I will cover everything. Because, see, I am not setting the paper, right? I don't know what will come. So you should know everything. Hmm. So, who may act as an auditor? Firstly, you should know who can be an auditor. So, to be eligible to act as an auditor, a person must be a member of a recognized supervisory body. Example, ACCA here in India, ICAI. If you go to Canada, it will be CPA Canada. If you go to Australia and New Zealand, it's going to be Australia, CPA Australia. If you go into USA, it will be CPA USA. So whatever regulatory body that particular country has when it comes to accounting, that body's degree is mandatory to be an auditor, or someone directly authorized by the state. Or if there is an exception by the government in any country, we do not have it here in India. But if at all there is any country on the world map and they say that we do not require this accounting body's degree, we are okay with other degrees also, then that can also be valid. It is just that it needs to be legal and authorized by the government, that is by law there in that country. Individuals who are authorized to conduct ordered work may be. Now once it is established that who can be an auditor, this means who is eligible to be an auditor. This means what kind of degree do you require. Now what comes is how can you operate as an auditor. You can be a sole practitioner. You can be just one person who started his firm and you are operating individually. You are the only person, right? So that becomes a sole practitioner. Second is partners in partnership firm. Now, if you talk about Big Four, KPMG, Deloitte, PwC, EY, they are not companies; they are firms, and each wing has its own partner, right? So. When it comes to partnership firms, there'll be a lot of partners. So that is how you can operate, and this is how Big Four operates. Members in a LLP company. Now, you can get yourself registered as either partnership or an LLP. What is the difference between partnership and LLP is something which is a part of your corporate law course. So you will get to know about the difference in corporate law subject. It is not relevant here for audit paper, which is why I'm not getting into the depth of it. It is relevant for your law paper and you will get to read about it in law. You can also be director in an audit company. Now, if we talk about Protivity, I'm giving you very practical examples here, okay? Protivity member from Global or Protivity member from India. So, like EY, KPMG, these have their headquarters in London. But Protivity, Deloitte, they come from USA. I repeat it once again. There are we have big four, which is KPMG, EY, PwC. Now, these three started their practices from London. They hail from UK and they have their headquarters in London. Deloitte was started in USA and it is headquartered in USA. Protivity was also started just like Deloitte in USA, and it is headquartered again in USA, New York City, or I guess it's Washington, DC. So while Big Four operates as firm, but Protivity is registered as a company. So there are different modes through which you can get yourself registered. I'll repeat them. You can be a sole proprietor, sole practitioner. You can get yourself registered as partnership firm. You can get yourself registered as LLP, or you can get yourself registered as a company like Protivity. To be eligible to offer audit services, a firm must be controlled by a member of a suitable authorized supervisory body. Like I said, every and any member and firm that they get registered, it is all being regularized by a supervisory body. Like every chartered accountant, every ACCA is being regularized after becoming a member. Also, you are regularized by ACCA body, right? If you want to open up a firm, if you even after registering your 3 years of articleship, you change your job, you intimate them on your portal that I have changed my job, I am working in this company, this is what I'm doing. Because as a regulatory body, they should know what you are doing as their member. A firm directly authorized by state, and that body should be authorized by the state. Give me a moment. Why, who may not act as an auditor? Now we know who can be an auditor. We should now know who cannot be an auditor. The law and most countries exclude those who manage or work the company. I already told you your stat auditor cannot be your employee, cannot be the company's employee, and those who have business or personal connections with them from auditing the company. Or it could be that, say for an example, I am director of XYZ company, and somebody from my family, like close family, which comes in the definition of my family, say for example my mother or my husband, or my child, becomes an auditor of that company. Now that person who's auditing, that relative of mine, that family member of mine, if that person is auditing the books of my company, he will not be independent, because we have a relationship, right? So that person, even if he's a chartered accountant, he will not be allowed to audit my books, because here independence factor comes in threat. So there is no hard and fast rule that even if you are an ACCA, you can audit any and every company. No, there are certain rules and regulations that you got to follow. Exceptions to above rule. Ex-employee is eligible in case cooling off period passes. I told you in the beginning of the class also that there is a concept of cooling off period, which is of 5 years. If you are giving your services to a particular client of for start audit, and once that period ends, there has to be a 5 year of cooling off period, which means that for 5 years you will not audit their books of accounts. And once that cooling off period ends, once those 5 years end, from the 6th year, you can again start auditing their books. And if you are an ex-employee of that company, say for an example, I am an ACCA, I'm working at Urbanic as an internal auditor. Once I feel that I need to make a switch, I leave the organization, I open up my own firm. Now I am not a part of that organization, I am no more their employee, and I have an ACCA degree also. So I can go to them and I can say that I want to be your stat auditor, and I will be allowed to be their stat auditor, because I am, ruling out all the checklists that is required to be a stat auditor for them. Excluded by code of ethics. Auditors must also comply with the code of ethics. Now you have a different chapter when it comes to code of ethics, and we'll read it there. The code of ethics requires the auditor to consider any factor that would prevent them from acting as an auditor, which could be your independence, which could be your competence. Like for an example, I can have 10 years of auditing experience, but I cannot sign any company's tax audit report, because I have never worked in taxation department. So I can take up that assignment, but again, as for code of ethics, I should not. I have studied that paper, but I have never practically conducted a tax audit. So I am not a competent person to act as a tax auditor. Or issue regarding confidentiality. Coming to the next chapter, auditor's rights. Now, what are your rights and what are your duties? During appointment as auditor, access to the company's books and records at any reasonable time. See, once you've started an audit, and post starting an audit and during your audit, you can ask for any kind of record, any kind of books, P&L, balance sheet, today's, last year's, last to last year's. You can ask for any kind of data from the client, which you feel will help you form an opinion. To receive the information and explanation necessary. Like I told you, you can sit with the client, you can go to the client and ask for information, and you can also ask for explanation. Like I said, when I was giving you an example of bad debts percentage, right? So you can ask for an explanation that if the industry standard says it's just 3% or 4% of debtors, why are you booking it at 10%? Right? So you can ask for an explanation, and it can be a written explanation. Please keep in mind, when you are working as professionals, you do not rely on verbal communication. You always rely on only written communication, because only written communication is an admissible evidence. To receive notice of and attend any general meetings of members of the company. Say, for an example, do you people know what AGM is? Please write in the chat box, because this again requires some amount of corporate law knowledge. All right. So as an auditor, you can go and tell your company that you have an AGM. You will be using my report, my audit report in the AGM. I want to be a part of your AGM. So the client cannot say that no, you can't come, and or maybe you can't attend my AGM. No, they don't have that right, because it is your right. You can attend whatever meeting that you wish to attend within the boundaries of the law, to be heard at such meetings on matters of concern to the auditor. Now, once I'll continue with the above example, you go and you attend an AGM, right? Now, there you feel that there is something which you came across during your audit period, and pose, even if you've given your opinion, you've given your audit report, you feel that it is very material for those who are attending the AGM to know from your side of the perspective. So you can go to the stage, you can take up a mic, and you can, talk to the people who are attending the AGM, get what you are saying in the AGM documented in the minutes of meeting, because you have that right. You have the right to speak to people. Okay. So the client at that point of time cannot restrict you, cannot say that no, you can't go on the stage and you can't talk to our shareholders. You have all the right, because those shareholders are the ones who are using your audit report in order to form their opinion. So you have the right to uh, go 2 or 3 steps ahead, surpass your client, surpass the management, and take steps as you feel are necessary to receive copies of any written resolution of the company. Now, there could be different amount of written resolutions. For an example, your director's report, your AGM report. So you can ask the client that whatever happened in the AGM, I want minutes of the meeting. I want the minutes of the meeting. I want to what all. Do you people know that there are resolutions being passed in AGMs and EGMs? These are the meetings which are conducted by the companies for their shareholders, and they are conducted for a certain amount of resolutions to be passed. Like, for an example, in AGM, you pass written resolutions of what will be happening in the next year. There could be an EGM being called, which is an emergency general meeting. There could be something which is of very good amount of relevance. It is very material, which the shareholders should know. Or maybe there is a resolution which is to be passed by the shareholders, post which only the company can go ahead and do its business. So there is a consensus, a green flag which is required by the shareholders. So then there is a written resolution to be passed. So as an auditor, you can go to your client's management and say that, look, AGM happened, I want to know what all resolutions have you passed, give me a copy of those documents, I want to read them. Or there is a directors meeting that has happened, right? You will study in your corporate law that there is a, by law, it is mandatory to conduct these n number of meetings by the directors. They have to meet for these many times in a particular year. So, and in those meetings, minutes are prepared. In those meetings, why are the directors meeting? Basically, they are meeting because they have to conduct business. They have to take decisions which are important for your business, right? So they also pass certain resolutions when they sit for the meeting. So what all resolutions did the directors pass in their directors meeting? You can go to your client and say that I want copies of those resolutions which were passed in directors meeting, and client cannot restrict your scope here. On resignation, to request a general meeting of the company to explain the circumstances of the resignation. Like I told you, you cannot just resign and go. You will have to tell people. So you can ask the client that, look, I am resigning, but I want these many people to be there when I resign. So you will have to conduct a meeting, and in that meeting, I will formally withdraw from this assignment. So client cannot say that you are not their employee. You just don't write a resignation mail and go after 3 months, right? So client cannot say that, no, I will not conduct your resignation meeting. You just write me a mail. No, this won't happen. To require the company to circulate the notice of circumstances relating to resignation. Now, what happens is, client might have screwed up a lot, because of which you are resigning, right? Because it is not a very often situation when an auditor resigns. Something might have been very wrong, because of which you resign. So it is not important to just resign. It is also important to tell people of why have you resigned. So once you say for an example, the client agrees on the first point, that is, a meeting is being called and you wanted 10 people to be in that meeting, but somehow those 10 people were invited, but only 5 people came. Only 5 people were in the position to attend that meeting. So what happens is the reasons are also documented, that what did you speak in that meeting. So you have the right to go and tell the client that you have to circulate the notice of circumstances of my resignation. You have to tell people of why are you resigning, and it is the company's duty by law to circulate the reasons of why are you resigning. Okay. Now comes your auditor's duty. Who asked about it? I think somebody. Uh, was it Madhvi or Harshita or Somi? Somebody asked me about this. So here it begins. The external auditor's primary duty is to audit the financial statements and provide an opinion on whether the financial statements give true and fair view. ये तो I think अब तक you would have memorized also. They may have additional reporting responsibilities. Now, apart from just auditing your financial statements and saying that they give a true and fair view, there are certain amount of additional responsibilities upon you. Let's just read what these are. Confirming that financial statements are properly prepared in accordance with those laws. One is preparing the financial statements, and the other is to prepare those financial statements as per laws that are applicable. So you are here saying that yes, it is giving true and fair view, but you are following the law when you are preparing those financial statements. Maintain adequate records and returns. So once you are preparing financial statements, you will have to record them, you will have to preserve those copies, and you will have to file the returns also. Like again, I'm saying in corporate audit, in corporate law paper, you will get to know that that set of financial books, which is your balance sheet, P&L, your cash flow statement, trial balance, notes to accounts, all of that, once it becomes a set and it is authorized and approved in the AGM by the shareholders, it goes to your MCA. You have to file it to the MCA also. In India, I'm talking about Ministry of Corporate Affairs. You have to file your financial statements to them. So is that being filed? And there is a time span written as per law that once the AGM ends, say for an example, within 30 days or within 60 days, you are supposed to file your financial statements to so and so governing body. So is that also being filed and within time? Ensure finance statements agree to records. Like I said in the first part, your opening and closing balances, like you close a particular assignment for this year, when the next year you go for an audit, you will always look back. You will always see what did I recommend last in my last audit assignment. You will always see were there any are there any open points, like I told them to do this, have they implemented it? You will always check their closing balances and opening balances match or not. Ensure consistency of other information, like it's again a very practical example. Consistency could be in policy, consistency could be when it comes to your adopting IFRS. I'll give you two examples. So let's talk about inventory. So inventory valuation, IFRS says that you can either follow LIFO or you can follow FIFO. LIFO is last in first out, FIFO is first in first out. Now these are the methods which help you in valuing the inventory. So last year, it was client was following LIFO. Last year also they were following LIFO. This year they started following FIFO. So there is a change, there is a shift, right? So why did that shift happen? Why did the trend break? Why is there a need for change in policy? And if at all there is a change in policy, you will have to document it and disclose it in the in the notes to accounts. So you will have to ensure all of these activities also, that if there at all is a change in the accounting policy being followed by the client, what is the impact of that accounting policy? First of all, how many accounts does it hit? Is it hitting your asset side? Is it hitting your liability side? Is it going to go in your balance sheet? Will it impact your P&L account? You should have a holistic view. You should have that level of knowledge that you can have a holistic view. Once you have that, you will ensure that it is being correctly and appropriately disclosed in the notes to accounts, that there is a change. You will have to also, basis your professional judgment, understand that is it justified and is it as per law to change the accounting policy or not. Again, the last one is disclosure of directors' benefits. How much of benefits are directors getting? What is their remuneration in comparison to the rest of the employees? How much is the salary gap? As per industry standard, I hope that my client is not giving way too much of a remuneration to the directors. Are they getting just one salary, or are they also working as consultants? So they are drawing two types of remunerations from my company. So you look into those also. And this again, disclosures for directors benefit. What all benefits do the directors get is also a part of your corporate law. You will study it in that subject. This is just a disclaimer. Now, who appoints the auditor? First and the foremost thing, who will appoint you? Members, that is shareholders. Now, what happens is people end up thinking that it is the management, it is the director of that company who has appointed me. But no, whether you will be appointed as a auditor in that company or not is the decision of the shareholders, who are your equity shareholders, your preference shareholders, who have invested in your business. Sometimes it is the bank. Like for an example, company is doing very bad financially, and they are on the verge of liquidation. So it is being taken over, the management is being taken over by the bank, because bank is somebody who owns the maximum amount, right? So it is the bank who will decide that who I want my auditor to be. It is never ever the senior management of the client that decides who the auditor is. Of the company appoint the auditor in general meeting, director filing casual vacancy. So what is the process? Okay, let me just go through, read it out for you, and then I'll explain. Directors can appoint the first auditor or to fill a casual vacancy. This requires the members' approval, that which is called as ratifying, at a members' meeting. In some countries, the auditors may be appointed by directors as a matter of course. Now, there are 3-4 things that you need to pay attention to, and this is an important topic for your subject. So what happens is, a company was newly incorporated. It has just come into play. So first auditor will be appointed by the directors. But again, a director has appointed the first auditor. But once they start conducting business, there will come a point that they have to conduct an AGM. The auditor that they have appointed will have to be approved by the members, by the stakeholders in that meeting. I'll again give you an example. XYZ company was incorporated in April. Okay? Now, directors of those company appointed, say for example, me as their auditor. Now they've appointed me as an auditor. I start performing my duties. Post April, before say November or September, there is a timeline within which a company is supposed to conduct an AGM post its incorporation. So, say for an example, they conduct an AGM in August. Okay, now in August, when the first meeting happens, I will have to be approved by the members in that meeting that yes, Srishti Shukla can be our auditor. If at all members say that no, we don't want Srishti Shukla as our auditor, I will have to stop my services. I will have to resign. I will be removed. And then they will start looking for another auditor. Who will start looking for another auditor? Directors, because they are the one who are running the business. They will again find somebody else as another auditor. And once that auditor is assigned, then again it has to be approved again in another meeting. And once that auditor is being approved in the meeting, he will be a permanent auditor because he will be approved. I till the time I'm not approved by the stakeholders, I am not a permanent auditor. I'll be a provisional auditor. Now, what is casual vacancy? When does casual vacancy happen? Say, for an example, an auditor was performing his duties, and client uh, removed them. Client said, I don't want you to work as an auditor. Or there was an auditor in place, they were working, performing their duties, and they conclude that we don't want to be your auditor, so they resign. Now, if an auditor is removed, or if an auditor resigns, there comes a casual vacancy. Now, that casual vacancy can be filled by directors. But again, if that casual vacancy is filled, it again needs to be approved by the members. Example for this is Byju's. Deloitte resigned as their auditors. Now there comes a casual vacancy. So Byju's can go to EY. Byju's directors will go to EY and they'll say that our auditors have resigned. Please join us as a stat auditors. EY auditors can join them as a stat auditor, but once the meeting gets conducted of the stakeholders, they will have to approve that yes, we as investors, we as shareholders want EY as our stat auditors. If they get approval in the meeting, EY can continue being their stat auditors. If they do not get any approval, they cannot continue, and then directors of Byju's will have to start looking again for another stat auditors. Now, Secretary of State, if no auditor is appointed by the members or directors. Now, what happens is directors are not able to find any company has recently gotten incorporated, or maybe Saint Byju's, when Deloitte resigned. See, it's a big firm, right? So people will have doubts that why did Deloitte, a firm like Deloitte has resigned. So maybe they directors of Byju's can go to EY and get rejected. They can go to KPMG, and KPMG can also say that it is too risky to handle your assignment. We don't want any blot on our goodwill, so we don't want to be your stat auditors. Now what happens is that Byju's directors are going everywhere, but they are not able to find any stat auditors. So then what can happen is that Secretary of State will appoint uh, uh, an auditor for them because they are not able to find an auditor. Auditor must be appointed for each financial year unless director bases the ground that financial statements are unlikely required. So mostly every financial year is to be audited, and for every financial year to be audited, you should have stat auditors in place for every financial year. You cannot have a gap that for this year there were financial auditors and then for another year you did not have financial auditors. This cannot happen. There has to be consistency, and you better have a stat auditor for all the years. Auditors in case of public companies are appointed from one AGM to the next AGM. So now it is a well established fact that auditors are appointed, get approval in AGM. Now what happens in a public company? Public company may from one AGM to next AGM, your auditor will be approved and appointed. So this is the time frame that they've given you. Auditor for private companies are appointed until they are removed. So if there is a private company, once you have been appointed as an auditor, till the time you are not removed, you will remain as an auditor. But if you are an auditor of a public company, every AGM you need to get an approval of the shareholders that you are continuing as an auditor. Why does this happen? Because again, very less people are interested in private companies, less amount of rules and regulations. And in public company, not only does it have a lot of shareholders, it also has government in play, and a lot of people rely on a lot of people get affected when it comes to a public company. So there it is a requirement that on every AGM you need to get an approval. But in a private company, once you are approved, till the time you are not removed, you remain as an auditor. Now, why is this important? Again, somebody asked me whether this is just theory or not. Now you can look at it as just theory, or you can come across a question, a case study, that you were operating as an auditor in a public company and you got approval in first AGM, you kept on giving your services and you did not check because you did not know only. So you did not check that in the second meeting you did not get the approval. So you have to be very updated, and you have to apply your brain that in the next year when I am doing their audit, am I approved by the members or not? Because if you are not approved, no matter how much you perform, you are not authorized to sign the report by the shareholders. So now that comes as application of the theory. So please be very good on your concepts before you start, solving the questions. Now comes the removal of your auditor. Why is the auditor removed? Okay, I think Madhvi asked me this, right? Madhvi, please write in the chat box. You were the one who asked me about removal of auditors, if I'm not wrong. Yes, so Karthik, ratifying means approving. It is giving your approval in the AGM. So removing the auditors. Removal of auditor can usually be achieved by simple majority at general meeting of the company. So in the general meeting, if the majority members say that we do not want this firm to be our auditor, you will be removed. It is game of majority. There are some safeguards such as specified notice period. So before you will be removed as an auditor, you will be given a notice period to serve. It can't happen that till yesterday you were an auditor and today you are fired. No, world does not work like this. So you will have a specified notice period within which you have to wrap up your work. You have to collate your working papers. You have to write why are you being removed, what went wrong. You have to document all those things, so you will get the time for that within that advance notice period. To prevent the resolution to remove the auditor being suggested at short notice. See, you can't be removed at short notice, like I told you, right? Client will have to inform you that I don't want you in order to influence the outcome of the vote. Now, this line is very important. Influence the outcome of the vote. See, if you got in a tough fight with the client, or maybe you caught something, right, which was extremely wrong, and in order to save themselves, the client says that I am removing you as a stat auditor because they are afraid that what you got might get into public. So ultimately, you have a better goodwill in the market. You are being called as a professional. People rely on you. Had they relied on only the client, there would have been no need to conduct an audit. Shareholders appoint you as an auditor because they have a certain amount of doubt on the management of the company that they are holding shares of, right? So they will want to listen to you. So what happens is, if you got into a fight or if you caught something which the client's management wants to hide, they say that we are removing you as an auditor. But they will have to first give you an advance notice that they are removing you as an auditor. And still, client's management cannot remove you. What happens is, you were approved in the meeting by the shareholders, and you will be removed in the meeting by the shareholders. Now, how do they take a decision? Client will tell them this happen. You will have your share of say, and you will then let the shareholders decide whether they have to remove you or not. So sometimes what happens is, the shareholders say that no, we want to continue with this auditor, so you will remain in your position even if the client's management doesn't want you, because you were appointed by the members. You will be removed only by the members. So this is what this line says, that being suggested at short notice in order to influence. Now, why influence comes, you should have a good PPT. You should have your reasons jot down, that why is the client removing you, why do you want to continue with the work. You will have to influence the members sitting in the meeting, the shareholders sitting in the meeting, so that they do not vote against you and they vote in your favor and you continue as an auditor. The auditor can circulate representations stating why they should not be removed if applicable. Like it was earlier, that you have the right to make a presentation in the meeting, and you also have the right that what you have said, what you have presented should get circulated around. People should know that why you should not be removed. People should know that why you want to continue. There could be that you have got something which is extremely wrong, and you want that to be documented and circulated, which is a reason that, see, I found this, I am helping you to make a good decision. I am doing my work with all the responsibility I can. So I don't want to get removed from this assignment. You will have to get that circulated. You will have to ensure that client's management circulates it and within the time required as per law. A statement of circumstances must be sent to to company and the regulatory authority to set out issue surrounding the cessation office. Now, like I told you earlier, you are being governed by certain amount of regulatory bodies, ACCA, ICAI. So you will have to get your representation, your statement circulated to these bodies also, that why, what happened between you and your client, what is your reason that you want to continue, and what is the final discussion. Are you continuing as an auditor or are you not continuing as an auditor? Arrangements for removing the auditor have to be structured in such a way that, so if they want to remove you, what is the structure, what are the steps that the client has to follow? These are those steps. The auditor has sufficiently secured tenure to office to maintain independence of management, financial security. Now, what is it saying? Arrangements of removing the auditor have to be structured in such a way that the auditor has sufficiently secured the tenure. He had the tenure in the office. He was given an opportunity before removing him. He had an opportunity to perform his duties. He had an opportunity to perform the audit. He was given an independence. Auditor, if the client wants to remove you, he'll say that I gave all the data that was required and asked for by the auditors. I gave them the appropriate independence which was required for them to work as an auditor. I gave them the financial security. I was giving them their fee that they asked for. Like I told you, that your fee structure is mostly on an hourly basis, and you might receive payment on a monthly basis also. But payment is always received on a monthly basis or a quarterly basis, but the charges are yearly basis. So client will say that I gave them the data, I gave them the independence, and I gave them the financial security also, that as an auditor that they demanded for. But as for me, they are not working in the best interest of my company, and so I want to remove them. The auditor can be removed if there are doubts about their continuing ability to carry out their duties effectively. Now, what happens? When can there be an instance when auditor's ability to continue can be in danger? Now, what happens is that there is a firm wherein there are 3 to 4 partners. Say, for example, there are 4 partners. Now, 3 partners, because of their misconduct, either their degrees were taken, or they resigned from the firm, or the partner that was conducting stat audit, the partner who was asked to sign, who was supposed to sign the client's stat audit report, his degree was revoked or he was jailed, and there is no other partner who wants to take up that client's assignment in that firm. So you don't have anybody to sign your report. So in that manner, auditor can be removed, because even if the team is working, the partner is not available, there is nobody available to sign the report. So it does not matter if the team is working well or not, because nobody will be able to sign the report. And that is the entire objective of getting a signed report from the auditor. Now comes the remuneration. The remuneration of auditors, which will include auditors' expenses, will be fixed by whoever made the appointment. In many countries, auditors' remuneration must be disclosed in the annual financial statements. Now, there are 2 things here. When the auditor is approved, is given an approval that you will become our auditor, he is given an approval by the shareholders in the general meeting or an AGM, right? At that point of time only, the auditor's fee is disclosed to the shareholders, and they agree on this fact also, that yes, we want you as our auditors, and yes, we agree on the remuneration that you want from us, because ultimately the money belongs to the members, the money belongs to the shareholders, it is their money, so they should have the right to decide whether they want to give you that amount which you are asking or not. So it is in the agenda of the meeting that one, we will members will appoint the auditor, and two, they will ratify that this amount is to be given to the auditors. And in some countries it can depend from one country to the another, but some countries in the globe have this norm going on. This is a general practice in a couple of countries, that auditors remuneration is highlighted, it is disclosed in the annual financial statement. It is an altogether a different cost head in the in the PNL, which states auditors remuneration, and then comes your expenses in the PNL. Now comes resigning. When the auditor resigns, right? In practice, if the auditor and management find it difficult to work together, the auditor will usually resign. Now, if you are having facing a tough situation with the client's management, you feel that you are not feeling independent, the kind of data you want, the kind of help you want, you are not feeling comfortable in interacting with the client's management, so you can always resign. There could be a number of reasons. A couple of them are these. On resignation, the auditor issues return notice of the resignation and a statement of circumstances to the members and regulatory authorities. Now, this is something I told you in the beginning of the lecture also, that once you are resigning as an auditor, you will have to give a written notice, you will have to give a written letter, and you will have to explain that why are you leaving. You just can't say, write it in a letter that I am leaving. No, you will have to give reasons of why are you leaving, and who will you give these reasons to, and who will you give the resignation letter to. So see, if I am working as an employee and I was given an approval, I was given an offer letter by HR department. HR department is the one who got me onboarded, gave me the approval and my offer letter. So I will write my resignation email to the HR. In a very similar manner, uh, auditors are being approved by the members. So when they resign, they intimate the members. Second, auditors, ACCAs, CAs are being regulated by authorities. So they do tell their regulatory authority that I am resigning. The auditor's responsibility on removal or resignation. So there are two things: one, removal, other, resignation. There are two types of duties. When an auditor is being removed, the one who is removing, which is your client's management, if they are proposing your removal, they have the responsibility to follow certain steps which we talked about here in this para. And when you as an auditor are resigning, you have certain sets of responsibilities that you have to fulfill when you are resigning as an auditor. The following is taken from UK law but provides an example of typical responsibility of auditors. Deposit at the company's registered office. A statement of the circumstances connected with the removal or resignation, or a statement that there are no such circumstances. Deal promptly with requests for clearance from new auditor. Now, there are four people involved. As we can see, one, you intimate the members. Two, you intimate the regulatory body, which is regulating you, which could be ACCA in your case. Three, the government bodies. You have to tell them also, like here MCA. You have to tell them also of why are you resigning, and you have to give them the reason of resignation as well, because you are auditing financial statements, and financial statements are registered with MCA, right? So MCA should know that this time the financial statements will not be attested by the auditors, and why. So the government body you are answerable to. Next is the new auditors. The fourth person is the new auditor. Like I told you, if Deloitte has resigned from Byju's, and if EY says that, okay, fine, now we will become the new auditors of Byju's, EY has the right to communicate to the ex-stat auditors, which was Deloitte. EY partner can, ring up to Deloitte partner and ask what went wrong. Why do you think I should not take up this assignment? Or why do you think I should take up an assignment? Third factor, which is very important, is when a previous auditor is removed or has resigned, the incoming auditor should ensure that that previous auditor's fee or remuneration is being paid off by the client. So that is something you should keep in mind. Ultimately, we are in the same profession and we are here to help each other. So when EY joins as an auditor, they will make sure that Deloitte's fee has been paid off. So you deal promptly. So what does the second point says? I'm so sorry. So what does the second point says? Deal promptly. Deal promptly means you have to act quickly if there is a request for clearance from new auditors. If EY says that we are coming the next week and we want to start our assignment, you have to wrap up your work, you have to give them all the documents that they require, and you have to leave. So you have to be very swift and you have to reply to the incoming auditor as well. Now, these are the accounting bodies who have framed your accounting standards, your auditing standards, assurance standards, your code of ethics, your international accounting standards, and quality. They define what kind of quality is expected from you. I think when I'll give you, when I'll share this PPT with you all, you can just read it. It is not important. Nobody is going to ask you, but they can be an instance where an MCQ could come. So just keep these names in mind. And now this is the explanation of which body does what. So I would request you all, once you get this PPT, these are the bodies, and just go through what which body does, right? In case you come up with any questions, there is any confusion in the role of different bodies, after you have read this, we can discuss it in our next class, and I can go in depth and explain to you whatever your doubt is, but I think it'll be done once you read through it. So I think it's the right time we can end our class. And then next is maybe we'll meet the next week for your third class. From next week, in your third lecture, we will start with a more of like a paper oriented mind. We will start with your accounting standards, and from the fourth lecture, we will start solving questions also. Okay, and I'm sharing this PPT and last class PPT in the AA group, AA live batch group. Okay, bye bye.